The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A warm Friday welcome to Squawk Box. I'm Steve Sedgwick with Karen Cho, and these are your headlines. Alphabet shares rising in extended trade after reporting a top and bottom line beat, with its search and advertising units showing strong growth despite increasing AI competition. ECB Governing Council member Robert Holzmann tells this very channel he expects further rate cuts to come, but says the outcome of tariff talks will ultimately decide how much lower the base rate will fall.
Looking towards the future is always a little bit of guessing. Maybe 2, maybe 3, maybe 1. We don't know yet, but there may be further cuts this year, but the number is still outstanding.
Bank of England Governor Andrew Bailey tells CNBC exclusively that he doesn't think the UK economy is on the brink of a downturn, despite the latest warning from the IMF.
I don't think the UK economy is close to recession at the moment. We actually, of course, had quite encouragingly positive last GDP number.
Nissan flags a record loss of up to $5.3 billion due to impairment charges as new CEO Ivan Espinosa attempts to turn around Japan's third largest automaker. I dare say the market needed this outing from Alphabet. It had a lot of Dow news around AI, and I think Microsoft making a decision around its leases for AI data centers really cast a net far and wide about what sort of demand we're looking at for AI demand. So this outing from Alphabet, the capex intentions remain there, that it still very much believes that the AI investment is worthwhile. Some of it's bearing fruit, not all of it. Also how it's dealing, given the trade tensions and advertising pullback. I think this was a welcome outing overnight, and the market really had a lot to sink its teeth in around the AI story.
I would probably agree and disagree with you. I as ever, I think that makes the show. I don't think actually the real meat on the bones was anything to do with AI, really. It was about the fact that the core bread and butter is doing really, really well. And that's what the market wanted from confidence. AI is a nice to have. It's nice to know for the market that all that money being spent is actually having some immediate impact. And I wouldn't disagree that it's having an immediate impact, but I think by and large, it's the advertising revenues that is absolutely key for this, the vast money-making machine that is Alphabet as well. So I'm not saying binary, it is or it isn't. I'm just saying AI is important. And the spending being kept in check, and we've seen how the market likes to keep in check. For instance, Meta cutting back on spending on VR, which not a lot of people saw in the last 24 hours, but I thought that was quite interesting. So when these companies spend too much on something the market gets worried about, then the market thinks, hang on a second, where's the revenue generation? So I'm really pleased to see the fact that the revenue from advertising, that was key.
I almost wondered whether they've now sort of set a trap for themselves, that the market is very sensitive to any signs that if there's a pullback in capex, it would signal that there is something wrong with that AI cycle. Because don't forget, these companies, Alphabet and Microsoft, really at the forefront of the hyperscaling story in AI. But the fact that you saw Alphabet keep its capex intentions despite all the headwinds out there, all the lack of uncertainty that we saw really expressed from other corporates, the $75 billion in capex intact. So I wonder if you get a change at the likes of Meta, if you get a change at Amazon and beyond on that capex intention, whether it does undermine some of the confidence that I think Alphabet restored in the market yesterday.
The market loves capex when it loves it. It hates it when it hates it. I know it sounds really quite a trite kind of basic comment, but the market gets really excited at certain stages of the cycle when it says we're spending on this shiny new thing, whether it's .com, whether it's cloud, whether it's the metaverse, whether it's AI in this case as well. But when the market doesn't see, and it's a very impatient mistress, the market, when it doesn't see that expense turning into revenue and the ergo profit a little bit later on the line, then it gets becoming a very demanding mistress and saying, well, why are you spending all that money on this one as well?
And Zuckerberg saw that in recent years.
And Zuckerberg saw that as well. So I think you hit you're spending on the new shiny thing at the right sides of the side of the circle, the cycle, then it really, really benefits your share price. But again, a little bit later on in that cycle, then the market gets more
Which is
demanding.
why I'm surprised that the market really did want to see this capex intact. You'd think with all the pressures coming to bear that any cut to that capex would have been welcome, but simply actually the opposite.
But the margins were really strong and no real signs yet of a softening of the ad cycle as well. And I know we're talking about AI, but on the capex, but ad cycle, search, margins, these are all key metrics which we need to see.
There's an AI story in the search, and you may have noticed that the AI, when you do a search, it subtly changes with the results that you're getting now, and that's been somewhat rewarding for the company, particularly for advertisers that feel like they're getting in front of customers. And Alphabet and Intel both posted beats on the top and bottom line, and both cited concerns over President Trump's trade policies. Google's parent company reported strong growth in its search and advertising units despite AI competition heating up, while admitting the company is not immune to the macro environment, saying Trump's decision to end the de minimis trade loophole will hit its advertising arm. That's right, all those Temu and Shein ads that they're missing out on. Intel disappointed the market, issuing weaker than expected guidance, saying fluid trade policies increase the risk of an economic slowdown and a recession.
The bread and butter of the US economy is jobs. If people keep their jobs, then there is a chance of economic growth, there is a chance of spending. So we all look at the jobs, although some of you say, it's backward looking, indicating it doesn't matter so much. Well, it does. And that's why we look at the weekly jobless claims as much as anything else. And these are really, really showing very little sign, tiny sign of any loosening in the market. The jobless claims actually rose very modestly last week, coming in at 222,000, which is, as you look at that, that's a great chart. Thanks, guys, for putting that up as well. Look at that. It's pretty much in line with most of the moves we've seen over the last year. There is no tangible, aggressive softening of the job markets from this number. Now, it was in line with expectations, pointing to ongoing strength in the US labour market, despite uncertainty, just around about everything else at the moment, including the Trump tariff policy. However, the Cleveland Fed President Beth Hammack told CNBC the Federal Reserve is seeing evidence that trade uncertainty and the prospect of rising tariffs is weighing on American businesses.
What we're hearing right now is that the uncertainty is really weighing on businesses, and it's creating issues for them in terms of planning, in terms of thinking about where they're going to go. And so some of them have put pauses on whether they're going to make bigger investments, whether they're going to invest in new facilities, new capital plans. And then they're thinking about their hiring plans. They're thinking about their labor force, and do they have the people they need? How many people are they going to be able to keep on for what length of time?
Let's take a look at some of those high flyers stateside as the boards moved again to the upside. Dow, S&P, NASDAQ, and the high flyers, Goldman Sachs for the Dow. It was Microsoft for the S&P 500 and for the NASDAQ. So real big drivers that have previously led the market forward also back in action as the market puts on more gains. Third positive session in a row is what we've witnessed. Two treasuries, still some concern about what we're witnessing in treasury markets after the shocks of the last number of sessions from Jay Powell early in the week, just how certain his job was, to what we're seeing still with the China tariff negotiations. And that 10-year, we're perched at 4.30, although we have pushed off the 4.5% mark. We're 4.76% at the very long end, the 30-year, as the market also sees that just push off that near 5% level. So a little bit of relief coming through, but the question is how stable these levels are at this point. The dollar, though, it has had a bounce for the first time in a month, and this is how we look on some of the ranges as a result. Euro has slipped. We're down close to 0.5%, so it's giving back territory. The 113 handle where we're travelling. Pound with 132.87, also down 0.4% morning session. And it is greenback going for gold against all of the other pairs this morning in a reversal of the recent trade, so high versus the yen and the Swissy. To the Asian markets for Friday, this is how we're looking to wrap up the session. Japanese markets recapturing all of their losses since Liberation Day, since earlier in April, which is fascinating. So that market again, 1.8% high, and you can see the 35,600 plus on the index level. Hong Kong firmer, more than 1% gains, stronger too for the South Korean market, but just a subtle increase for the Chinese market today. European futures, let's see how we're going to get going today on the back of what has been a very strong run for some of these markets. The FTSE, for instance, has been up 9 straight sessions in a row, a gain for the trading week of about 1.6%. German stocks, 6 positive session out of 7. I think you're getting the picture. There's been some appetite again for Europe, so we're looking at modest signals to the upside this morning.
As ever, I have a problem with everything, and I have a problem with my next read, actually, because an individual country in Europe, such as Germany, are they negotiating with the US, or is it Brussels? It should be Brussels, isn't it? Because the reason I mention that is because of this. German Finance Minister Jörg Kukies has told CNBC Germany is in active negotiations with the US. Yeah, in a bid to secure a trade deal. But I don't think Germany's got the remit, has it? Sylvia will know. Anyway, he's optimistic also on finding an agreement. Speaking to our very own Carolyn at the IMF spring meetings in Washington, D.C., Kukies said he believes the transatlantic relationship can return to its former strength. Really? Wow. Even under the Trump administration.
We are having very constructive discussions with the government in Washington. I met the finance minister in several occasions and meetings here. I'm seeing the trade representative. I'm seeing the economic advisor to the president. Those are all very constructive discussions. Of course, there's differences, especially on trade and tariffs, but everything is going in negotiation mode, so we're optimistic to resolve the differences.
Are you optimistic that a 0 for 0 deal will be arranged?
That would be our preferred outcome. Of course, the United States has answered to the 0-0 proposal on industrial goods that we also need to talk about services and agriculture, but that's the part of the regular negotiation process that we always have. Maroš Šefčovič, the European Commissioner in charge, is leading that negotiation because we've delegated the authority on trade to Europe. But everything is going in the direction of a very constructive exchange, and we're hoping for a deal soon.
You sound pretty optimistic, but a lot has happened in the transatlantic relationship over the past 2 or 3 months. The trust has been broken. Don't you see that? Wouldn't you agree with that? Well, and how can it be restored?
I think for trust to be broken, a lot more would have to happen because the transatlantic partnership has been built over so many decades that we will not get carried away by the statement of tariffs, especially because everyone I spoke to, and I was in Washington right after the automotive tariffs were announced, was that ultimately there is an interest in finding an agreement. So in that sense, we're still negotiating. It's of course there's different interests, and we need to understand the US side. The US side needs to understand our interests. But this is not the first time ever that the United States and Europe are negotiating over tariffs. So I don't think we're anywhere near a crisis moment.
There you go. Cookie's answering my question. It's good, isn't it? Maroš Šefčovič is leading those conversations.
Although when it comes to the pointy end, like autos, they're willing to pick up a phone, get on a plane and get involved because it's such a large sector of their economy.
Negotiations are done by the EU, by the Commission. That's a fact.
I didn't argue that. I said, but they're willing to pick up a phone or hop on a plane to have a conversation if there's a problem in a major sector.
That's not what I was saying. I was saying who leads the negotiations.
Well, let's push on. ECB Governing Council members are weighing up how rising trade tensions and tariff uncertainty will play out at the bank's next meeting. Let's take a listen.
The question is what kind of political decisions will be taken. Is it that we will have some tariff increases? Is it that we will have a strong tariff increases? That we will have a retribution by high counter tariffs? This is the direction to do. And then of course this high uncertainty what we currently have you can find everywhere. You can find it at the level of growth. You find it at the level of changes in the financial markets indicators there. So at the moment we look at everything and try to make sense out of it. But for the time being, it's too early to say this is the data to look at.
If one takes a look at the growth outlook, then of course most of the risks are on the downside. Weaker economy, of course, would also mean somewhat weaker labor market, which we already are seeing in the data. We see that vacancies are slowing down. We see that wage growth is slowing down, very much in line with our earlier forecast. So far so good in terms of dealing with inflation, but we'll see, of course, what the uncertainty brings for the economy. And then, of course, what are those implications for inflation dynamics going forward?
So it's too early to say whether I'm on board or whether I would not be on board. There is just too much uncertainty yet. I would need to see a more structured analysis of the impact on the inflation profile ahead of us. And only then can I say whether the market is pricing fair or whether I don't. I would disagree.
The managing director of the European Stability Mechanism, Pierre Gramegna, stressed the importance of reaching a trade agreement with the Trump administration, but said the latest IMF projections show that the US is set to suffer more from its own tariff policy.
What we need is a dialogue and find concrete solutions, but having a trade war is detrimental to all, and it has hit the United States growth more as we see with the IMF forecast, than it has even hit Europe, as the forecasts have been revised down due to these uncertainties on the one hand, and the risks that trade slowdown are putting on the world economy.
Coming up on the show, Alphabet posting stronger than expected revenue growth, sending shares higher after hours. We'll break down those numbers, plus Nissan slashing its guidance as the automaker grapples with the effects of Trump's trade war. We'll be live in Tokyo, and we're going to be speaking to the CEO of a company really in the spotlight, defense firm Saab, later this morning. Don't miss that conversation, 8:10 British summer time.
Alphabet shares jumped in extended trade after the tech giant reported stronger than expected revenue and profit in the first quarter. Net income rose 46% year on year to $34.5 billion, while first quarter revenue at the Google parent came in at just over $90 billion. Its core search and advertising business grew nearly 10%, boosted by its AI offerings. The CEO, Sundar Pichai, told investors on the company's earnings call that it continued to bet big on AI as a driver of growth.
AI is one of the most revolutionary technologies for enabling and expanding our information mission. And for search, we see it growing the number and types of questions we can answer. We are already seeing this with AI overviews, which now has more than 1.5 billion users every month. Nearly a year after we launched AI overviews in the US, we continue to see that usage growth is increasing as people learn that search is more useful for more of their queries. So we are leaning in heavily here, continuing to roll the feature out in new countries to more users and to more queries.
Let's get to Melissa Otto, who is head of TMT Research, S&P Global Visible Alpha. Melissa, there's been a huge headwind from the trade tariffs and the uncertainty we're getting from Washington. But what we heard yesterday was that, look, some of this AI story might just be intact. How welcome was that?
It's an interesting point for the entire AI theme right now. It'll be interesting to see how it evolves over the next couple of quarters. One of the big things that came out of Alphabet's earnings is that they're going to continue to maintain their CapEx level of $75 billion. So I think, all systems go in terms of what they're rolling out.
I wanted to ask you about the AI parts that we saw in the business yesterday, because what we heard from Pichai was that the summaries, the AI overviews, are effectively these links above the web pages that are being served up as relevant ones when you conduct a search. Now, 1.5 billion users per month. How strong is that number when there's a whole heap of competitors crowding in, the likes of ChatGPT, Perplexity, Anthropic? Was that number strong enough to suggest the moat is intact?
It's still really early days to gauge that. It reminds me of the early days of the internet, when we had all different types of ways to try to access the World Wide Web. And I think that's really what we're coming up against here. It'll be interesting to see how they are able to position and pivot search in a way that it essentially makes it as monetizable as the current search model is right now. One of the other things that came out of the quarter was that the company did speak to some headwinds around ad revenues going forward. So as you've got this, massive CapEx coming online for AI, and at the same time, ad revenues potentially seeing some friction, some resistance in the market, potentially from the macro environment. Where does the rubber hit the road there, and how how does the monetization come to fruition in the same way?
Melissa, one of the links here was that, look, if we've got a slight revenue slide at all in the business, what is that going to do in terms of impacting the CapEx intentions? Now, we've seen the CapEx intentions, they remain intact at a very high level. But one area where we did see some slippage, and this has been a real workhorse in recent years, is cloud. And it wasn't just at Google, we saw it over at ServiceNow as well. The slowdown we're seeing in cloud, how strong is that? And will it have an impact at some stage?
Yeah, I mean, cloud in Q1, it actually came in from a revenue perspective, a little bit better than expectations. But from a margin perspective, very strong, 18% margin. Visible Alpha consensus was expecting 15%. Going forward, it's a little bit lumpier. And the company did call out that they do expect that deployment to expand much later in the year. So I think we could see potentially a couple of quarters where the cloud business is potentially not as robust as we have been seeing.
Hey, Melissa, just a couple from me. Just on the other reasons why this stock is underwhelming this year. I mean, to my mind, it's still down around about 16% year to date. How much do we need to worry that the Biden era chasing of these big monopolies, as they would call them, is just carrying on under the Trump administration, and that the DOJ has got this one in its sights as well?
I mean, that worries me much less than the fact that the market currently has consensus is at a 33% operating profit margin for fiscal year 2025. And the company called out that depreciation is going to essentially significantly ramp in tandem with this $75 billion in CapEx. So the big question out there is that 33% margin potentially at risk as we think about the rest of the year, and that would slow their earnings growth quite a bit, and that does put the valuation into question.
And I hear you, but look, the sum of the parts is very interesting compared to the breakup value, but this one is very much still in the firing line for the DOJ. There was a federal judge ruling in Virginia as well. They've lost two separate cases now over at Apple as well. Sorry, beg your pardon, at Alphabet. Is that not, I mean, again, whether it's broken up or one company and the margins are what they are, but is it not really a clear and present danger that this company is going to be broken up?
I mean, I couldn't comment on that. I mean, it'll be something certainly to watch, but I'm much more focused on the fundamentals of the business and how the company.
Melissa, sorry, that is fundamental to the business, whether it is one company or several, isn't it? Isn't that a key fundamental you have to be looking at?
I mean, it is, but I mean, we can't really forecast that. You can't quantify exactly what the valuation of the company is going to look like, or how we can't build assumptions around that can put a price around what the company is valued at. We can say that it's a risk.
But isn't that what you do all the time, Melissa? Look at the sum of the parts and work out whether it's worth what the market's saying it does or not. Isn't that what you do?
It's not based on a factor like the government. We just watch it and maintain, a look at it and try to understand how it could potentially impact the fundamentals of the business in terms of how, that will shift in terms of where the growth is going to go and what will change the business model. Currently, we don't have any of that. We don't have any evidence of that.
We have a lot of evidence, but the DOJ is winning cases left, right and centre. But Melissa, we'll have to agree to disagree. Thank you very much indeed for your time. Melissa Otto, Head of TMT Research at S&P Global Visible Alpha. Right, US Federal Trade Commission, and this is kind of my point about the concern about monopolies. The US Federal Trade Commission Chair, Andrew Ferguson, has told this channel that the ongoing trial with Meta was aimed at protecting American consumers. As part of the antitrust trial, the FTC is looking to force Meta to spin off Instagram and WhatsApp. Surely we've all got to be putting this into the equation as a potential scenario. It may not be our central bell curve distribution scenario, but it is a scenario. Don't we have to I don't know, maybe not. Okay. In an interview with our US colleagues, Ferguson said it was important that the FTC saw the case through.
When Facebook acquired Instagram and WhatsApp, it did so to suppress competition in one of the markets that's most important to American consumers. All of us saw in 2020 how much power these platforms have, not just over our economic lives, over our social lives, our political discourse, our elections. All of us saw how powerful these companies are. That's what this case is about. It's about protecting Americans from the incredible market power of these companies and making sure that companies are competing with each other on the merits so we get innovation and growth.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.